Do barriers and borders make us stronger? Can smaller supply chains make markets rise faster? Are countries safer when they turn inwards? Or has the world started making itself poorer? The world is changing.
America first.
United States of America.
Supply chains look vulnerable and barriers are being built.
We must protect our borders.
But is this new wave of protectionism just a passing trend? Or could this be the beginning of the end of globalisation? Here at Capital.com, we make explainer videos about trading and economics, giving you insights on the markets so you can make informed trading decisions. We're also a trading platform, so you can make your trades right on our website or using our app. After this, you might want to check out our recent explainer on the bond market crash. While you're watching this film, you can order almost anything you want from anywhere in the world. Trains, planes, ships and cranes will deliver it to your door at the cheapest possible price in the shortest possible time. The iPhone in your pocket is the product of a truly global effort. While it was designed here in California, it uses suppliers in 43 countries and elements from 6 continents. These abnormal privileges were normalized by globalization.
Being smart means you know that you always have to be pushing for more open trade and increased trade volumes, because the only way a rich country grows richer is to increase its trade with its trading partners.
The architects of globalization had a dream. The free movement of capital, goods and labor wouldn't just make us better off, it would make us safer too.
Globalization is often summed up in the phrase, the world is flat. And that refers to a 2005 book by Thomas Friedman, in which he put forward this golden arches theory of globalization. And what that meant was that no two countries that have a McDonald's will go to war with one another.
From Genghis Khan's Silk Road to the spice routes and the Suez Canal, mankind has tried to make the movement of goods and capital faster and cheaper. But globalization as we know it was turbocharged by one thing in particular: the flow of capital.
It really took off after the Reagan-Thatcher revolution. If you think about globalization as the movement of capital, goods, people across borders, one of the things that we saw post-1980s is that capital moved a lot faster than either goods or people. And the banks were in part the sort of ambassadors, let's say, of globalization. You saw capital markets around the world really connecting tightly. That increased asset prices in certain markets. It also increased wealth in certain markets.
Free market bulls believed goods would be manufactured at the cheapest point in the supply chain. Barriers to trade would fall and consumers would pay less and less for whatever they wanted. And in some ways, they were right. Global trade exploded, growing from $2 trillion in 1980 to almost $14 trillion in 2007. As outward-looking manufacturers found new ways to undercut their competitors, complex supply chains began spreading around the world. Capital flows, or the movement of money for investment or trade, rose to $1.8 trillion by 2007. This new phase of globalization changed the world and created its share of winners along the way. It's estimated to have brought 1 billion people out of poverty since 1990. But the big winners were the companies that got rich. Really rich. American corporate profits rose from over $280 billion at the end of the 80s to $2.5 trillion in 2022. But the bigger those corporate profits grew, the bigger the cracks that appeared in the foundations of globalization. And 3 big shocks to the global supply chain spread those cracks around the world. Back in 2007, as George W. Bush was surging American troops into Afghanistan, and PetroChina became the world's most valuable company, the world was knocking down trade barriers as fast as it could. The percentage of trade to global GDP almost doubled in 2 decades to 61% in 2008. Lightly regulated banks loaded themselves up with debt and sent capital racing across borders and continents. But then came globalization's first supply shock.
Lehman Brothers staff arrived at work in London this morning to be told the bank had been put into administration.
Excuse me, sir, how are you feeling?
How do you think?
Investment banks like Lehman Brothers, who had grown rich selling on toxic debt packages filled with subprime mortgages, started going under. The flow of goods, capital, and trade collapsed, and job losses started piling up in countries thousands of miles from Wall Street. The benefits of free trade looked more like a vice than a virtue, and the percentage of trade to GDP fell to 52%. As the world slowly recovered from the financial crash, it looked ready to forget the lessons of toxic debt. But then came supply shock number 2.
COVID-19 can be characterized as a pandemic.
COVID-19 spread around the world faster than financial contagion and shut down global trade routes overnight. The share of trade to GDP fell back to levels not seen since the height of the credit crunch.
When you start to get supply chain disruptions for all kinds of reasons in major goods like PPE and pharmaceuticals and things that are really crucial to survival, you even saw disruptions in food supply chains at that time, energy supply chains. Suddenly, people realize, wow, the things that might work really well for companies on their balance sheets when everything's working well may not be so good either for companies or societies when there are more disruptions.
But just as the world started feeling safe, sharing the same air, this man got itchy feet. As Russian tanks rolled into Ukraine, Western Europe hit back with economic sanctions. The cost of imported Russian gas soared, and the world suffered a third supply shock. The shared strength of global trade was starting to look like a reckless risk. On top of that, consumers had begun asking themselves the true cost of their cut-price goods.
One of the big light bulb moments for me around supply chains was the Rana Plaza factory disaster in Bangladesh. And that's when you had a poorly constructed factory in a country with very low environmental, labor, and regulatory standards, caught fire, collapsed, and killed over 1,000 people, injured many more. This outsourcer of textiles was actually making garments for major Western multinational brands, H&M, Walmart. And these companies didn't even realize who was making their product because there were so many layers of outsourcing to outsourcers to outsourcers. That kind of risk, even though it might look great on the balance sheet when you look at the numbers, I can make my garment for $1 instead of $15. When you begin to tally in the human costs, the reputational costs, certainly, and the market costs, you begin to see these risks that exist in highly efficient supply chains.
But it wasn't just black swan events that caused some to look beyond a globalized world. There were also political pressures at play. Back in 2016, America exported $114 billion worth of goods to China. But China, with their cheaper workforce, sent $406 billion of goods back the other way. And for Donald Trump, the culprit was clear.
Because China, 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 China.
The UN did a very interesting study a few years back looking at who the major beneficiaries of globalization in the last 40 or 50 years have been. And on the one hand, you've got global capital, and in particular, kind of the 1%, as we might say, the C-suites, the folks that are owning most of the financial assets around the world. But on the other hand, you have China. And why would that be? Well, because one of the big bargains of globalization was an exchange of cheap capital from the West, and in particular from the US, and cheap labor from China. So you see both of those entities really benefiting.
Financial elites were blamed for profiting off workers in faraway lands, and he had a simple 2-word solution.
America first.
He brought in 25% tariffs on imported solar panels, steel, and aluminium, and China hit straight back. Chinese tariffs on American goods rose from $34 to $185 billion in 2 years, while American tariffs on goods coming the other way grew over twice as fast. The idea that globalization was to blame for the loss of local jobs spread across borders and continents, and it became known as populism.
Over the last 20 years in particular in the West, a lot of voters began to feel hey, the global economy is not working for me, and there are a group of technocratic policymakers that are, kind of floating up here at 35,000 feet, but I'm down here on Main Street, and I don't know what, these policies are doing for me. And I think that that's why you got things like the rise of Trump, but also the rise of Bernie Sanders in the U.S. I think it's part of the reason that you got Brexit in the U.K. and nationalism on the continent.
Back in 1990, there were just 4 populist governments. By 2021, that number had risen to 17. As globalisation fell out of fashion, American politicians struggled to put the protectionist genie back in the bottle. And while President Biden hasn't used the phrase America first, he's used taxpayer money for the same effect. He promised $52 billion for the semiconductor industry and $370 billion for the green tech sector. The only catch? It all had to be American-made.
The United States of America.
But have these attempts to put America first benefited American citizens? The trade war is estimated to have cost the American economy $250 billion and 300,000 American jobs, while trading opportunities for other nations has picked up by 3%. What happens if countries decide, like an 80s American cop, that they're better off working alone?
I think what we're realizing is that place matters. And one of the big mythologies, I think, of globalization was that place didn't matter anymore, that you could simply create jobs at a global level and all those would rise and everything would be fine. We stopped realizing, I think, that we could have governance at a national level and markets at a global level. And at some point, those two start to crash into each other. And that's what we're coming to terms with now.
Countries and institutions may have to decide between supply chains that are complex and cheap or short and stable.
There's statistics now that show that about 90% of multinational companies are starting to rethink, localize, and regionalize supply chains for all kinds of reasons, not just geopolitical risk, but energy costs, transport costs.
For now, we are still living, working, and trading in a globalized world. A recent survey shows the number of US companies who are planning to move from China back to America was 0. Free markets and open borders haven't spread peace or solved inequality. But the promise to build walls wasn't a solution either. The future may be decided on whether or not consumers can accept a higher cost for less choice. Until then, there may be a price to pay for living in a globalized world. Thanks for watching. Remember that the price of stocks and shares may vary depending on changing market conditions. You can read more of our analysis by clicking on the links in the description below. And don't forget to subscribe to stay alerted to our regular chart analysis videos each week and other explainers on big financial topics of the day.